Okay, let's unpack this. We're diving deep into the Q2 FY26 results for Chalet Hotels Ltd. But this feels like far more than just a typical quarterly earnings report, doesn't it? We're looking at what seems like a really critical moment here, defined by a strategic overhaul, a major leadership transition, and, well, the bold launch of a brand new hospitality vertical.
It's fascinating, really. The sources, when you dig into them, they paint this picture of a company evolving, moving from just being a successful asset owner into becoming a fully integrated brand-led platform. So our mission today is basically to decode the implications of that pivot, how their core real estate strength is fueling this ambitious new brand.
And the backdrop is just, well, it's quite something because of that transition you mentioned.
Yeah.
Dr. Sanjay Sethi, the MD and CEO, actually announced this would be his final earnings call in that role. That's after 26 consecutive quarters. So this deep dive feels almost like a capstone moment for his tenure, right? Culminating in launching what he specifically called a fully integrated brand-led hospitality platform.
Exactly. And reflecting that confidence, that strength, the board also declared the company's maiden interim dividend, just €1 per share, but it's a first one. So you put it all together, the strategic expansion, the leadership change, the first shareholder payout. It really signals, I think, immense confidence in delivering long-term value.
Okay, let's get into the numbers then. The financials first. The consolidated numbers look enormous. Total revenue surged 94% year-over-year to $7.4 billion. Consolidated EBITDA up 98% to $3.1 billion. I mean, those are headline figures that just scream massive success almost overnight.
Well, yes and no. We really need to filter out the noise from the residential side. Those huge consolidated figures, they're heavily skewed by revenue recognition from the residential project. When you isolate the core business, so hospitality and commercial real estate, the growth is still very robust, but it's more, let's say, sustained. Core revenue was up 20% year-over-year to $4.6 billion. But interestingly, core EBITDA jumped 25%.
Okay. So profitability is actually outpacing revenue growth in that core business. That margin expansion, that says a lot about operational efficiency, right?
It does. It really does. This core business saw a pretty healthy margin expansion of 144 basis points. That's a 1.44% jump in profitability, pushing the margin up to 43.4%. It definitely confirms the effectiveness of what they call their double engine strategy. Hospitality assets working alongside that annuity-yielding commercial real estate.
Right, the double engine.
Yeah.
Okay, let's break those engines down. How did the main hospitality segment fare on its own?
The hospitality segment revenue, it grew a solid 13% year-on-year to $3.8 billion. Now, that growth was overwhelmingly driven by pricing power, specifically average daily rate, or ADR. That jumped 16% year-over-year to $12,170. But, and this is the key point, that strength came with a trade-off. Occupancy dropped quite steeply, actually 7.0 percentage points year-over-year, down to 66.7%.
Okay, that occupancy dip is definitely notable. A 7-point drop while ADR soared like that. What were the specific reasons management gave beyond just, pushing rates?
Yeah, they pointed to two main things, one internal, one external. Internally, it was the unavoidable drag from new inventory addition. In the first half of the fiscal year, the company added 166 new rooms. That included 129 keys at the Bangalore Marriott Hotel Whitefield and 37 keys at the newly launched Athiva Resort in Khandala.
Right. New hotels always take time to ramp up, don't they? They dilute your overall occupancy percentage until those new rooms stabilize.
Precisely. They're assets in a ramp-up phase, as you'd expect. The second factor was external headwinds. They specifically mentioned severe rain-related disruptions, which particularly hit their northern resorts, like the Westin in the Himalayas. Plus, apparently, the quarter just had fewer auspicious dates or long weekends compared to last year, which impacts, the leisure and wedding business.
So management's framing this as a 1 or 2 quarter blip. Is that the expectation then? Should we assume this pressure eases off next quarter?
They're certainly betting heavily against it continuing. Management sounds very optimistic that occupancy levels will bounce back to their strong historical performance in the second half of the year. They expect their recovery to be driven by the usual suspects: the festive season, more domestic travel, and the start of the IC season meetings, incentives, conventions, exhibitions, which always drives corporate bookings.
Okay. That confidence, even with these temporary dips, it seems directly linked to their big new strategic move, the launch of Athiva Hotels and Resorts. Tell us about this new brand.
Right, Atheo. It's being positioned as a new age premium lifestyle brand. They're specifically targeting affluent young travelers with the millennial and the Gen Z mindset. It's built on three core pillars: joy, wellness, and sustainability. Seems quite thought through. Even the name Athiva apparently comes from a Sanskrit word meaning abundance.
And the launch vehicle was the transformation of that iconic Duke's Retreat in Khandala, right?
Yeah.
Now it's the 147-room Athiva Resort and Spa, Khandala. So what's the plan here? What's the immediate and maybe the longer-term vision for Ethia?
Well, the initial strategy seems focused purely on properties they already own. Makes sense. They're basically unifying assets they were already operating themselves under this single new brand, hoping to create value through synergy and scale. Now, right now, it's actually a pretty small slice, only about 5% of their total portfolio. But the pipeline looks significant.
How significant are we talking?
They've already identified 6 properties earmarked for the ATIVIA brand that totals over 900 keys. And these include future developments in some key leisure and business spots: Navi Mumbai, Aksa Beach up in Mumbai, 2 down in Goavarka and Bambalam, and also a resort and convention center in Thiruvananthapuram.
Okay, that brings up a really important strategic point, though. In such a crowded, competitive market, why launch their own brand? Why not just stick with partnering with a major international chain for that global distribution muscle and those loyalty programs?
Yeah, that's a fair question. And their reasoning was actually quite insightful. They noted that the hotels currently under the Atiriva umbrella, they're primarily serving the domestic market. Take the Khandala property, for example. They said 80% of its business comes from just Pune and Mumbai. So their existing sales team is apparently strong enough to keep occupancies and rates healthy there. Global distribution just isn't as critical for these specific locations right now.
Okay, that makes sense for driving local traffic, sure.
Yeah.
But isn't creating an in-house brand going to mean significant internal marketing costs, distribution costs, things an established partner would normally handle? Are they really convinced the synergy gain outweighs that risk?
It seems they are. They presented it as kind of a dual strategy. They still fully intend to partner with big international brands for major city hotels that depend on global demand, like the upcoming Taj at Delhi Airport, for instance. But for Athiva, they stress that it creates a long-term springboard. That's the word they use. A springboard for a potential asset-light hotel management business down the line. That would move them further up the value chain.
Interesting. Okay, let's shift gears then to the commercial real estate, the CRE segment. That second engine that, well, makes all the strategic risk-taking potentially viable. What did we learn about the CRE performance this quarter?
Yeah, the CRE segment delivered really exceptional growth, and crucially, it maintained that super high margin profile. Revenue shot up 76% year over year to $738 million. EBITDA soared 88% year over year to $607 million. And that gives you a very, very high and consistent EBITDA margin of 82.3%. Really strong.
Wow. Okay, so if we connect that performance back to the bigger picture, this is where that financial fortress idea comes in, isn't it?
Yep.
What does this strong, reliable annuity income actually mean for Chalet's overall financial muscle?
This, for me, was probably the most crucial financial insight from the reports. The strong, reliable cash flows coming off that CRE segment, they are now apparently sufficient to cover the company's entire debt servicing obligation.
The entire debt servicing. Wow. That fundamentally changes the risk profile of the whole company, doesn't it? It basically turns the commercial real estate portfolio into a kind of financial safety net.
Absolutely. That's a great way to put it, a financial safety net.
Yeah.
And that enables the hospitality side of the business to pursue more aggressive organic growth, brand expansion like ATIV, maybe even some selective acquisitions, all while keeping financial discipline because, like you said, the debt is essentially ring-fenced by that annuity income. Net debt, by the way, stood at $20.9 billion, and they also managed to bring down their average cost of finance slightly to 7.62%.
And they also wrapped up their residential project in Bengaluru this quarter, which explains some of those huge top-line consolidated numbers we saw earlier.
That's right. The residential project in Koramangala, that accounted for $2.8 billion in revenue recognition this quarter. That was after handing over 55 apartments. They're nearly done there. Cumulatively sold 314 out of 321 units. And significantly, they successfully repaid the entire $2 billion preferential capital they got from promoters earlier. They're now expecting about 250 crores in residual cash flow from that project.
Okay, so moving beyond Q2, let's look ahead a bit. What key assets are defining their development pipeline right now?
Well, construction seems to be moving along nicely on several key projects. The Taj at Delhi International Airport is apparently on schedule to open in the first half of next financial year, so H1 FY27. They're positioning that very strategically as a highly transient-driven hotel, focused on high occupancy turnover, really leveraging the Taj brand's distribution network and loyalty base.
Makes sense for an airport hotel. And on the commercial side?
The second commercial tower, CIGNUS Powaya Tower 2, that's on track for completion in Q4 FY27. And there was definite positive movement on that highly anticipated Hyatt Regency at Airoli in Navi Mumbai. Seems like some Supreme Court orders are helping advance the necessary approvals, which they expect over the next few months. That's that unique high-rise hotel project starting way up on the 27th floor.
Right. And finally, we should probably mention an impressive non-financial achievement, something on their sustainability journey. What stood out in their ESG strategy?
Yes, this was quite a major milestone, actually. Achieved well ahead of schedule, too, under their ESG brand Parivartan.
Hmm.
Chalet Hotels became the first hospitality brand in India to hit the climate group's EV100 target, and they did it as of September 2025, ahead of the goal. What that means is 100% of their guest transport fleet is now electric, and all their operational hotels have EV charging stations. It really shows a deep, tangible commitment to those pillars of wellness and sustainability they're building into the new HIVA brand.
Okay, so if we synthesize all of this whole deep dive, we basically see Chalet Hotels navigating these temporary hospitality dips pretty confidently. Dips caused by new inventory and maybe some bad weather, but crucially, they're backed by that incredibly robust performance from the commercial real estate engine.
Exactly. That foundational strength, the fact that CRE covers the debt, it effectively frees the company to pursue what looks like a riskier but potentially higher reward brand-led growth strategy with Ativa. This strategic move, combined with their strong balance sheet, really positions them, I think, to aggressively capture that premium domestic travel market increasingly through their own channels.
So the key takeaway for you, the learner, really seems to be the transformative power of diversification here. That commercial portfolio has essentially built a financial fortress, covering all the debt obligations, which, relatively speaking, gives the hospitality arm almost a blank check to take measured risks on things like new hotels and creating this new brand, HIVA.
And this raises, I think, an important question for you to perhaps explore as you track Chalet's next chapter. If the cash flows from that annuity business, the CRE, are truly sufficient to cover all their debt, well, just how much higher can they actually push their capital spending on these high-yield experiential assets without relying on traditional debt cycles? That could fundamentally change the whole scope and maybe even the speed of their future growth story.
That's a great thought to chew on as you reflect on this deep dive. Thank you for joining us.